So let me get a little bit into the substance of the work I wanted to present today. This was a lot starting when we were asked to think about resilience, how we define it, how we use it as a concept to support decision making. And at the time, I was working on disaster risk management at the World Bank, and one of the issues we had was the assessment of project and prioritization of actions. And so just to illustrate, our problem was, imagine you have a budget and you have two projects for coastal defenses on your desk, and you have to select the one that you will fund with your budget. If we follow our rules, we do a cost-benefit analysis. And so we look at the costs and benefits, and we just finance what's best. And so imagine you have two projects costing 100 million. One is bringing 20 million, the other one 5 million. No need for a fancy PhD in economics. Of course, the project A, according to our rules and the decision-making process that we're supposed to apply, project A is much better. Problem is, for disaster risk management, very often, what you get is the project with the high returns is in a fancy neighborhood, and the project with the lowest return is in a very poor area. And that's, of course, because poor people have few assets. They are poor, so they have limited wealth. It's kind of an obvious thing. And because the cost-benefit analysis of disaster risk management is focusing on avoided losses, there is only so much avoided losses in economic terms you can have in poor places. And so we always had this problem that our teams were bringing us projects, but they were saying, yeah, so the benefits, economic terms, are not so big, but the impact on people will be super high. But it was kind of like a qualitative thing, and what we were trying to do is to just have a more formal way of approaching that problem. And so what we did is we started from the traditional risk assessment. So I don't know how many of you in the room have worked on risk management, but it's always the same framework, right? You have the hazard, which is the physical event. So a typhoon with a certain wind speed, an earthquake with a certain ground shaking. It's purely a physical event. Then we have the exposure, which is the population and the assets that will be affected. And then we have the concept of vulnerability, which is if the exposure is affected by a certain hazard, how much is lost? And this is the way people are working when after a disaster, the next day you have this type of news article saying like, in that case, Puerto Rico lost like 43 billion. It's based on this approach. And they look at the buildings and the road and so on, and they calculate how much is being lost in the sense, what will be the cost to repair? But it's only asset losses, right? And so Puerto Rico would be 43 billions. In a place like Antigua and Barbuda with much poorer populations, you might have 300 millions. Those numbers are very difficult to interpret. Is 300 million a lot? Is not a lot. Very complicated. And of course, we have this problem, like the left is Haiti, the right is Florida. The damages on the right are probably much higher in economic terms. But of course, the impact on people's life is much larger on the left, and so that's really the challenge that we have in front of us. Can we better understand and quantify the impact on people? And so we did that by starting from this framework, but adding this concept of socioeconomic resilience, which was basically what translates the asset losses, so the value, how much you have to pay to replace and repair what has been damaged, to a notion of well-being losses. So what is the impact on people's and people's well-being? So this, as you know, there are like a million definitions of resilience. I'm not sure we made a big service to the world in defining one more notion of resilience, but here we are, we did it. So here it's very close to, I think, the initial definition of resilience, in the sense that this is about bouncing back. This is about absorbing the shock and being able to recover without suffering a lot of losses in the process. And so here we separate kind of the initial shock and its size, which is measured by the asset losses, And the socioeconomic resilience is about the secondary implication and the ability to recover. So I'll now discuss how we're doing that work. But basically here, the socioeconomic resilience is defined by this ratio of the asset losses, so how much you pay to repair, and an estimate of well-being losses. And so if you want to give an intuition on the metric, if you're Bill Gates and you have an infinite socioeconomic resilience, it means that basically you can lose assets, so you can experience economic losses as big as you want, and you'll have zero well-being impact. So you can lose your roof and your house and you don't care. It doesn't affect your well-being. If your resilience is zero, it means that any dollar of asset loss that you experience will have an infinite effect on your well-being. So how do we do that in practice? So the first thing is we will be doing that at the household level. So the unit of analysis to do this, we think, is the household. A lot of the risk assessments are done at the country level. Here, we really want to start from the household. And we start from the household vulnerability in the sense of where they live and what they own. And how do they make a living? By the way, I don't know if you know this work from by Peter Menzel. He's traveling the world and he's taking pictures of households with everything they own. And it's fascinating to compare the pictures from across the world, with some people owning almost nothing, and some people having like so much. So it's really a fascinating piece of work. But I think it illustrates very well that we want to start with the very concrete way people are living, and it's not only about what they own physically. We also want to map the instrument and the tools that they have to manage shocks. So when you're affected by a shock, you will be using the fact that your revenues might be diversified. So for instance, if you have a small field and you're growing maize, maybe also you have goats. And so if you're losing your maize 1 year, you still have an income from your goats. Or maybe you have like a little shop in the streets and you're not only living from agriculture. So revenue diversification is the first buffer for people when they're affected by a shock. And then if the shock gets bigger, they will use their savings. So maybe you have a little bit of cash at the bank, or maybe you can borrow to friends and banks. And if you're richer and you're affected by a big shock, maybe you have an insurance contract that will help you. And of course, there is a social protection in rich countries, and especially in Europe, when we're affected by shocks, we have government support systems that come to help. It's also the case in many other countries. So basically, it's really a combination of the physical things that people have and how they make a living, and the kind of like financial tools and support systems that they have around them. And that's our starting point. And so we have household surveys in many countries in the world that will have, I don't know if you're familiar with what they look like, but basically you have a set of households that have been interviewed, and we know their income, we know where they live, we know the assets they have, if they have social protection and so on. And for each of those households, we have a weight that gives us how much they represent in a population. And so that's really where we're starting from. And this is an example in one region in the Philippines. This is the histogram of consumption. So you see, you have the mode around 20,000 pesos per person and per year. And you have, of course, a long tail of rich people, and you have a shorter tail of people living closer to poverty. So that's really our starting point. That's the population that live in one place. And then what we're doing is, at the household level, we're doing a risk assessment. So we have, for instance, a flood map. We look at where people live, their assets, and we try to estimate how much they are going to lose in terms of assets. And that will depend on the characteristics of the shock. And that will depend on what type of housing they live in. Do they have livestock? Are they goats or cows? And also, do they have early warning system that makes it possible to, for instance, if you have like a little motorbike, you can move the motorbike out of the flood zones to save it and not to lose it. And so that's the typical risk assessment. Then we have a few steps. The first step is to translate asset losses into income losses. And here, that's where we're looking at how people are making a living. Where is income coming from? And it can come from people own assets. So if I have goats and I sell cheese, I own the asset and I get cheese out of it. But also from assets that people don't own. So for instance, I'm working in a factory. I don't own the factory, but the assets in that factory is how I make a living. And of course, the road that connects my dwelling to the factory, the road might be a public asset, but I also get an income out of this road, because if the road is destroyed, I won't be able to get to the factory and I won't get paid. And so the first step is really to translate those assets into income losses, looking not only at the assets that households own, but also the public assets and the other assets that they use to make a living. And so in that work, income household per household, we're doing an assessment of the income losses, and that includes the duration of the loss in income. But of course, if you have been affected by a disaster, not only you might lose income, but you will also lose consumption. And here it's a little bit tricky, because you will lose consumption because your income drops, but you will also lose consumption because if your roof has been damaged, you'll have to pay for the replacement of the roof, and that will take away your ability to spend on something else. And so the translation of income losses into consumption losses is more complex than a one-to-one relationship, because of the needs to spend on repairs, but also because you will be able to smooth your consumption losses, either because you get social protection support, because you use your savings and borrowing, or because you're insured. And so same thing, household per household, we will model the consumption loss. Just to give you an example, here I compare the impact on a household in Colombia affected by a big earthquake. And on the left, I have a household with no savings and no ability to borrow. So you have the drop in the assets of the household, a drop in income and consumption. And the challenge for the household will be this choice between cutting consumption a lot to replace what has been lost. So imagine your roof has been taken away. You will be cutting on your normal consumption so that you can pay to replace the roof very quickly. Or especially if you're very poor, you will not be able to cut consumption very much, because you need food and you need to pay for the school of your kids. And so you will not be able to repair your roof rapidly. It's going to take a very long time. And so households are facing this trade-off between cutting consumption very much so that they can replace their asset very quickly, or they can just do it very slowly, in which case the impact on consumption is smaller, but it's going to last longer. And how people will do this, here we contrast the case where people have savings or access to borrowing. If you have savings, then you can repair much more rapidly without cutting consumption. And so everything will be, not only the drop in consumption will be lower, but also the duration of the shock will be shorter. And to me, it's really striking that every time you see those numbers about the disaster impacts in terms of asset losses, the duration of the recovery is never part of the conversation. People look only at the drop at one point in time. What we do in this work is we're trying very much to understand the full path to recovery and how we can accelerate that. So that's a little bit how we're doing it at the household level. And so what we get is, earlier I was showing you the histogram of consumption in this region of the Philippines. Here you see when we model household per household, we can look at how this histogram is shifting to the left, because of the in that case it's a typhoon with a 1% probability of occurrence affecting the area. So what's good with this approach is that we can look at lines. So you have in the Philippines the poverty line and you have the subsistence line. and we can look at how many people are crossing that line. And so we can start talking about poverty headcounts, which to me is an extremely important dimension, because with all of the drawback of poverty headcounts as a metric, it's something that anyone understands. You go anywhere in any country and you say 1,000 people are falling in poverty, everybody understands that number. If you start talking about economic metrics, it's much more complicated to explain. So we have been using in our conversation with the public and with governments this number of people crossing the line quite a lot, because it's a very easy to explain indicator, and it really gives you something about the impact on people. So here in this region of the Philippines, you can have like about 4% of the population falling in poverty after a typhoon, which you don't see when you have an impact in pesos. We're doing one more step though. When you have the consumption loss, we want to take into account the pre-existing situation of the households to calculate well-being losses. And here I just want to take 1 minute to say, we're not trying to assess well-being. It's just, too complicated and so on. The only thing we're trying to take into account is the fact that if I lose $1,000 because I have to repair my roof, I will be able to cut on luxury consumption. I'll be able to go less to restaurants or to just buy stuff. Poor people will have to cut on food, healthcare, and education. And of course, the value, the well-being impact of cutting on fundamental basic consumption is higher. And so the way we're transforming that is a very awfully simple way of doing it. It's just like every dollar of reduction in consumption is valued more for people in poverty than in people richer. And so it's a very simple way of doing it, but it's really important to take into account the kind of trade-off that people will have to make on their consumption. Just one thing on the modeling. So earlier I was showing you this figure telling you that people have to do this trade-off between cutting a lot on consumption or taking a long time to recover. So household per household, we're assuming that people optimize. So they try to minimize the well-being loss that they experience from the shock. And so they decide if they will cut consumption a lot or not a lot to just minimize this trade-off between shorter and bigger shocks or longer but shallower shocks. And so the model is assuming perfectly rational households that are doing an optimization, trying to recover as well as possible. And of course, if you relax the constraints with borrowing, with savings, with insurance, and so on, they will be able to recover faster and experiencing less shocks. So I'll show you some of the results of this work that we do at the global level. It cannot be fresher. The paper was out yesterday at 6 p.m. So it's really brand new assessments. And so what we have been doing is, so we have about 140 countries. And I won't go much into the details, but we can discuss it a little bit more. The data challenge is enormous, right? So we have global risk assessments, but if you want to look at what people have to recover to shocks and their socioeconomic vulnerability, the data is not really there in all countries. So here's just to give you an example. Countries in green are countries where we have the data for some dimensions like what is so at the bottom left, for instance, the dwelling of people. What kind of materials is it made of? Is it like a modern building in concrete and steel, or is it like a hut done with recycled material and a bit of wood? And of course, it matters. Countries in green, we have the data. Other countries, we have to make assumptions or to do inference to try to guess that. It makes a big difference when you're affected by a disaster if you own your home or not. If you're a renter, you can just go and rent something else. If you own it, well, you're stuck. You have to repair. Same thing, the home ownership rate we have in some countries in green at the medium right panel in the countries in purple, we have to infer this information. So we're working quite a lot on data gaps and how to close data gap in a way that makes sense. But that's an everyday problem. And one thing that's we have all to be very aware of is the quality of the data in the world is not getting better. With all of the fanciness of the new remote sensing, AI approaches, digital data, and so on, what's happening is countries invest less in actually collecting data on the ground, and the result is that our data landscape is getting worse and worse in many places in the world. Interestingly, it's better in very low-income countries because people like us are doing the data collection. In middle-income countries, where countries are supposed to do the data collection themselves, things are not improving. They are deteriorating. So here is an idea of the results that we get. So you have 3 maps here, and sorry, this might be a bit small for you to see, but I'll describe what's going on. At the top, it's the risk to assets. So it's the losses in terms of what is being destroyed. In the middle, it's the loss in terms of well-being. And at the bottom, it's the socioeconomic resilience. So basically, it's the color describes the ability of the countries to experience asset losses while protecting their well-being. And what we see is so the risks to asset is not very much connected to income. So rich countries and poor countries are experiencing big losses in the same way, I mean, in relative terms. But of course, there is a bigger difference in resilience and risk to well-being. And what we find in this work is richer countries are more resilient. And internally at the World Bank, this is a big debate because you have some people saying we shouldn't look at resilience. We should just help countries becoming richer, and resilience will come with it. And so what we wanted to do with that work is to show that, yes, richer countries are more resilient, but first, there is a lot of variance. So at the same income level, you have countries that are much more resilient than others. But also, and this is the value of having a model, we can run counterfactuals, take a country, make it richer, and look at whether it's more resilient. And what we find, at least in this modeling framework that we have, is all of the increase in resilience doesn't come from income itself. It comes from correlates with income. So countries with higher income, they have more formal employment, and formal employment is very important. They have more financial inclusion, so people have savings and can borrow. They have more and better social protection systems, more insurance. And so that's the things that are coming with income that matter, not income itself. And so in our dialogue with governments, the idea is to tell them, of course, more income will allow you to become more resilient, but it really depends on how you develop and whether, for instance, your development is inclusive or not, because a lot of the resilience or lack of resilience comes from very exposed poor populations. So if you have pockets of poverty, like you find, for instance, in countries like China and India, the incomes are growing, but they have pockets of poverty where not much is happening. Those places will be extremely vulnerable, and so the increase in GDP is not sufficient. It's interesting because arguing for instance, more inclusive development path or more financial inclusion and so on helps us get some very concrete recommendations, because telling countries like you should develop and get richer, I mean, they kind of know, right? But being able to say, okay, in your country, a lot of the lack of resilience come from the lack of financial inclusion. So people don't have bank accounts, so they keep money in cash under their bed, and so when they are flooded, they are losing everything. That's the type of very concrete things that governments can do something about. We also see that when you compare across countries, poor countries take longer to recover. And so part of the vulnerability of poor countries is not that the shocks are bigger, but that the shocks last longer. And so for me, it's a very important thing because I've been arguing quite a lot on helping countries access rapid financing after disasters. and using the World Bank as a sort of an insurer for countries so that they can recover faster. Again, in that case, the slower recovery doesn't come from macro effect, right? It's really the household and the households interacting and the households financing their own reconstruction. And finally, if I dig within countries, here you have 5 income quintiles, and you have in green the asset losses, and you see richer people are losing more. So by that indicator, richer people are more vulnerable because they are losing more. Our well-being loss estimates gives us exactly the opposite, right? When you have poor people losing more in terms of well-being than richer people. So poor people, the poorest quintile is losing only 9% of assets, but about a third of well-being. Just to shift a little bit, I wanted just to mention this work that we did in the Philippines, where the difference is that we went subnational. And so I just dropped to the results directly. It's exactly the same approach. So as I was saying at the beginning, that the Philippines got to us because they had this fund and they wanted to know what to do with the fund and where to invest it. And so here we gave them basically a map of asset losses. And so the answer is, if with your fund you want to reduce asset losses from disasters, you have to invest in the Manila region. So you have to invest in the capital city where the richest population are located. If you want to use this fund to reduce the impact of disasters on poverty, so this is the crossing the line that I showed you earlier, then you have to invest more in the north and the northeast of the country, because there are places with a lot of typhoons and a lot of people close to poverty that will fall in poverty if affected. So the map on the left, you see only rich people. The map that you see, the second one, the red one, you see only people close to poverty. It's a very small segment of the population. And with the well-being loss estimate that we're doing, we're trying to find a balance, right? That you want to be efficient, so you want to spend where it makes a difference. But you also want to spend where people are more vulnerable. And so the idea here is to try to find an indicator that is a little bit more making that balance. And last map I wanted to show is the map of resilience, because that was something that we discussed quite a lot with the government. So if the goal of your fund is to make people resilient, then you will invest in the south of the country. And that's because that's where people are the poorest and the less resilient. But it's also a place in the country that is not affected by disasters quite a lot. So in the south, if you invest in this place, you're really helping the most vulnerable people, but they are not affected very often. So in a way, it might be seen as less efficient than being that investing in places that are affected all the time. But our point here was, and that's an important thing, I think, for people working at the World Bank, is we're not trying to tell countries what should be their priorities. We're trying to help transform their policy priorities into concrete actions. And so here, our answer to the Philippines government is, well, where you want to invest depends on what you're trying to achieve. If you can tell us our priority is poverty, our priority is financial losses, our priority is resilience, we can tell you what it means in terms of priority provinces to invest in. But there is no one-size answer that to say we should invest here or there. It completely depends on your policy priority. So in our engagement with government, we're always trying to keep this distance, that they are the ones legitimate to decide about policy goals. We're helping them transform those broad policy goals into concrete set of actions. I won't go too much into this, but just to say, like, we find, like, at the global level, that rich people are more affected in terms of asset losses, but less by well-being. And so we could tell them, for instance, like the uniform cash transfers that they were working with, where basically you give the same amounts to everyone affected by a shock, has some massive benefits for poor people. And so that's really the value of this redistribution after disasters that we're trying to assess. So just to conclude, and then happy to just hear your your questions and to dig deeper if useful. We're really trying to have in this bigger framework one part which is about avoiding disasters and impacts, and that's a lot of what people are focusing on. And this dimension of saying, because you cannot avoid all of the shocks, you also need to manage residual risks and impact. So in your country, it's really interesting on floods because so much work is being done on reducing the risk in the first place that you don't have a lot of residual risk. But for most countries, you cannot reduce the risk to a negligible amount. And so this second part of the equation of helping people recover is really, really important. And so this tool is just trying to do exactly that, like find a way of having a broader set of policies and to be able to assess and to provide, for instance, benefit cost ratios on also the part of the toolbox that's about resilience and recovery and financial interventions. So maybe I'll stop here and just listen to your feedback and questions, and very happy to give you more details on any part of this work or how it interacts with the rest of our agenda on resilient development in general.
Thank you, Stéphane.